What's up YouTube? This is Foxtail Digital coming to you again with Black Girl Stocks. And in this video, we're going to be going over how to trade options on Robinhood, primarily the app. I really want to gear the channel more towards options because, you know, it's the options for me. I think this is going to be a great introductory video because a lot of people are still using Robinhood, and this video is going to be good for traders who know what options are. So you're familiar with the terminology and you really just want to see it happen. And you want to see it on the screen and you need to see it. A lot of people are visual and you want to see it before you start. We're also going to go over what to look for when you're trading options, different advanced plays and strategies. And we're going to be talking about the difference between buying options, selling options, and closing options. There's definitely a difference in the three. So be sure to watch the entire video, okay? No skips. But first, if this is your first time watching this video, please click that thumbs up button. It really helps bring more people to the channel. And also make sure that you subscribe and click that notification bell so that you get notified anytime I upload a new video for you guys. While we're even on the topic of options, if you're new and interested in option trading, make sure that you check out Tiblio. It's an amazing service that offers great option trading plays. They have long call plays, puts, credit spreads, earning report option plays, and now they just added their implied volatility gap strategy. There's so much that you can do with Tiblio. I'll make sure to leave a link in the description below. Just make sure to use my link to get 20% off of your first month. All right, so let's go ahead and let's get into it. The first thing that you're going to want to do is make sure that your account is set and activated with options trading. Okay, so a lot of people ask me, you know, how do you do the options? So what you're going to do is you're going to go over here to your bottom right here and click on this little person thing, and then click in your top right. All right, so come down here, you're going to see options trading. So on mine, I'm on level 3, and then just make sure that you have options trading and activated. So when you initially get on there, you might start with level 2. Okay, so you'll have everything that you see here. You're gonna have buying calls and puts, selling covered calls, selling cash covered puts, and exercising options. The only thing that you're not going to be able to do are doing the spreads until you get a level 3. And we'll talk a little bit more with the spreads. It's just a little bit a more complicated strategy for the options, and it just gives you so many more options that you can do with your options. And once you've started trading with level 2, so once you've made about, you know, 5-6 option trades, then you'll be able to go ahead and upgrade to your level 3. We already know that the option contract gives you the right to buy 100 shares of a stock or sell 100 shares of a stock. So this is when we're buying and claiming ownership in the position. A lot of people are wondering about this, so I'll clear this up right now. So when you open a contract, that can either be a call or a put. Okay, you're going to be able to open and close these positions that you bought. All right, so trade options, open and close. Now, closing these is going to be the same thing as exiting your position. So that's like the same thing as buying a stock share and then selling it. So you open an option contract, or you buy a call or a put, and then you can exit that position. I hope that this is making sense. So I actually have a video that we did before on exiting option contract positions. I'll make sure to leave a link below for that one. So we're not going to actually go into that right now, but you can also make a profit by outright selling contracts. Okay, so you can sell it before you bought it. So you see how we have this buy right here. So you can buy the call or a put. All right. A lot of people outright sell or write contracts. A lot of traders do this for passive income. When you're in the seller's position, then you're going to receive that premium amount as a credit. Okay, so let's say right here we get one sundial call, we're gonna sell it, and here's the price here, so we can put in our price. I'll do the 0.44, and you see how it says minimum credit $44. We're going to be receiving that. Now before, when we were just buying options and we did it for 44, now pay attention, this is the buy. If we were buying this, then you see the max cost. That's because we're paying for it and we're buying it. So I just wanted to show you guys the difference between buying and selling it outright. We talked about that before in our earlier options one-on-one video, but this is, you know, a little refresher. A lot of times options are gonna expire worthless. So being the seller, you'd actually profit from that situation. Naked options, if you've ever heard that, that's just a strategy where you're gonna sell an option contract first, but you don't own those 100 shares. So it's really leaving you open to a lot of risk if the market moves against you, but you can profit from this without spending anything. So it just, it really just depends on your risk. So when you do covered options is when you own the 100 shares first. So let's say if you're buying an option contract and then you actually own 100 shares of that stock first. So honestly, whatever goes on with that contract, you'll be good because you actually have 100 shares that you can put up for that. So you actually own the 100 shares first, and then you're gonna write the option contract or sell it, okay? And that's a lot less risky because when you write or sell an option, then that's when you're gonna be obligated to buy 100 shares of that stock. Another thing I wanna mention is that not all stocks are gonna have options. Okay, this one, for example, I'm Cannabis. That's a cute name. You click buy here and you don't see any options here. So this one doesn't have options. If you go to FSD Pharma, this one does have options. Sometimes you'll find a stock that you like and that you want to trade options on. And when you open it, the only thing that you're going to see is buy or sell, but no options. So that's either going to mean that option trading isn't set up in your account yet, or that particular stock just doesn't offer options trading. So let's get into the actual contract. And we can just let's use Ford. Ford is doing really good right now. Trade options. You see your share price here. You already know you have your strike prices over here, and these are gonna be your premiums on your, your far right. So let's get into a contract. I'm just gonna pick one. Now, this is what's gonna be really important. You can check out your break even right here. Now the break even, this is the price that the stock needs to be at expiration for you to have gained profit, okay? By the expiration, this one is gonna expire on the 18th. By the 18th, the stock needs to be at least at 1668 for me to have not lost money. So yeah, click right here in your bid ask, and this is gonna bring your statistics down for the options. So each option is gonna have its own statistic. You're gonna focus on your bid, your ask, your volume, open interest, implied volatility, and your Greeks. These are going to be pretty important, okay? So what I want to talk about first is the bid and the ask. So one way that you can use the bid and the ask here is when there's a higher number on your bid, that means that there's a lot of selling volume. So value here may decrease shortly in time. And then on the opposite, when you see a higher number on your ask, that's a good sign that you're gonna have an increase in value. So right here, you see we have this 124 on our bid. So that means that right now, a lot of people they're selling this, or they're paying a lower price for it. So with options, the trading volume is going to be the number of contracts that were traded in a given time period. So that's usually going to be one trading day. You're going to look at this to help see the strength of the current interest in the option play. So if you have a high volume, then that shows a lot of interest in this play. And then you look right below that, you have your open interest. Now the open interest is going to be the number of active contracts open. So these are contracts that are open right now that haven't been closed out. And you can use the open interest and the volume together to gauge the options direction. When your volume is higher than your open interest, then that can be a good sign that, more people are interested in this, and it's going to increase in value. So you see right here, our volume is actually lower than our open interest, which kind of mirrors the high number on our bid. So these are different things that you can also use as indicators, kind of like the stock chart. But so now let's go down here to implied volatility. The implied volatility is the expected volatility of a stock to move for a certain period of time that option is open. From open to expiration. So how much is it projected to move while this option contract is open? Now, this is all going to be dealing with supply and demand. When expectations rise and the demand for an option play increases, then the implied volatility is going to increase at the same time. When you have higher implied volatilities, then you're going to have higher premiums. So that option is going to be more expensive. You see where we're going here? So this is going to be something to keep in mind when you're actually buying your option. So if let's say if you're looking for a deal, you're going to want to get the option that has a lower implied volatility, and then you're going to wait for it to increase, and then sell it when it's higher, okay? Another way that you can use the implied volatility is if you were doing credit spreads, or if you were selling options, like writing the option, then you would actually want to have a higher implied volatility, okay? Because that's going to give you a higher credit back. You're going to have a higher premium. So in those situations, you're actually going to want a high implied volatility. Then you have your chance of profit down here. So that's going to give you, your chance of profitability. So what is the probability? You have a 30% chance of this being profitable for you. Now, what's really important down here for your options are the Greeks. I have a video on the Greeks, so I'm not really going to go into details. That's pretty much it. I mean, I know this video it's pretty elementary, but if you found any value in this video, do me a favor, click that thumbs up button. Also, make sure that you subscribe and click that notification bell so that you get notified anytime I upload a new video for you guys. And I'll catch you guys on the next video. All right, bye. Yeah.